And guys, there is something that I want you to understand about equity funds. Sometimes we are chasing returns out here. We are seeing a fund that is doing very well. It is reporting a 37, a 47 something, it's reporting a 50 something return, but we don't understand how returns for equity funds work. We don't understand how they have calculated these equity funds returns. And if you don't understand this, sometimes it can be very misleading, because there's someone who is in that particular fund, they joined in a particular year, and then the fund started making losses, and even with that 50 something percent, they will still be in loss. And I think I should do or work on a video on how equity funds returns are calculated, because they are calculated very differently from other investment returns, and sometimes the returns can be misleading. And I think there is a lot to discuss about equity funds. I have received a few DMs from people who lost money on equity funds because they didn't know how they work. Please comment equity fund returns so that I will be reminded to come back and do this video for you guys, so that you understand how equity funds work before you lose money in an equity fund. Also, subscribe so that you don't miss out on this, and also don't miss out on other updates that I'll be sharing, especially for equity funds. As you do that, let us discuss the risk involved in investing in individual shares. And the risk of investing in individual shares is higher than investing in equity funds. This is basically because equity funds are diversified, but when you invested in an individual shares, it means that you are risking the whole amount in a single company. So if that particular company does not do well, it means that you're going to be losing a very big portion of your money, if not all. And worse, if the company does not recover, it means that you will lose all your money in that particular company. But you can mitigate this by diversifying the investment at a personal level, just making sure that your investment is not just in a single company, but you have also diversified at a personal level to just reduce the risk of losing money in a single stock. And this can also be mitigated by doing your due diligence well before investing in a particular company. You understand the company financial health, you understand whether they are making profit, whether they pay dividends, you understand all those things before going in, okay? Now, let us talk about returns before I give my views on which one you should invest in. And I think returns, here we are talking about which one has better returns than the other, or has better potential returns than the other. So for shares, the potential returns are a bit higher than those of equity funds. And again, I think this is because of the diversification feature. Remember, we have said that by law, the company or the equity funds are allowed to invest 10%, at most 10%, in a single company. So if that company does well, they're going to be only making profit from the 10% of the fund. But if you have invested in shares and you have invested in a company that does very well, you can make a lot of profit from it, because you have maybe put a lot of money in it. You will be in so much profit you won't believe it. And you can make a lot of money in shares as compared to equity funds when it comes to when a company does very well, okay? So in short, shares offer better potential returns than equity funds, okay? And then the other thing that I wanted to discuss is the fact that when it comes to equity funds, they usually issue statements monthly or regularly, and you don't have to keep monitoring the markets every now and then to just know where the prices are. You can see that in the shared statement because you're dealing with professionals here. But if you have invested in individual shares, you need to be monitoring the market. It's not daily, but you need to be monitoring the market regularly so that you don't miss out on when to sell your shares so that you can make profit. Sometimes you can stay in the market for so long, you miss out on opportunities to sell your shares, okay? And finally, on differences, shares are more volatile than individual shares. Equity funds are more steady and less volatile as compared to individual shares, because again, we go back to diversification. Because now equity funds are well diversified, the volatility is not as much as investing in individual shares. And before we talk about what you should invest in, let me mention a few similarities of these two investments so that we also appreciate the similarities, okay? And the first similarity is on the dividends. And I know, although most equity funds do not issue dividends, there are some that do issue dividends. We have growth equity funds whose focus is capital growth, and you only realize your profit when you're exiting the market or when you're selling your units. While we also have value equity funds. These are equity funds that invest in undervalued companies. And then we have what we call dividend funds, which targets companies that pay regular dividends. You can find an equity fund that only invests in companies or in shares that usually give dividends. So depending on which company you have invested in or you have opened an equity fund with, you might be receiving dividends, where in other companies you will not be receiving any dividends. Okay. The same goes to investing in shares. We know some companies issue dividends while others, they do not issue big dividends. Now, to our final part of this video, which one is better? Where should you invest your money? Here is what I think. If you are a beginner investor and you already put money into a safe investment like a money market fund, but you're ready to diversify, start with an equity fund. It carries moderate risk, higher than money market funds, but lower than individual shares, and it's managed by professionals, making it a very great first step. And remember, you take a baby step. Do not go all in at once. Take baby steps as you grow. Start with equity funds. It's going to give you an exposure of how shares work, and just to show you, or just to introduce you to a moderate risk investment. Now, if your risk tolerance is low, equity funds are a smart place to start. Over time, as your confidence grows, you can begin exploring individual shares. But if you have a low risk tolerance, I would advise you to go for equity funds. If you are a busy professional who doesn't have time to open a CDS account, do your due diligence, research on companies, and track markets, then equity funds are tailored for you. These are your funds. You need to invest in equity funds rather than investing in shares, because shares is a bit of work. It requires you to be monitoring the market. It requires you to do your due diligence. It requires you to do a lot of work for you to make sure that you have gotten the right investment and you're not losing money in that particular investment. But for equity funds, they're going to do all the work for you, and they're going to be investing on your behalf. So, who should invest in individual shares? If you are hands-on with your finances, if you're enjoying doing your own research, you follow business news, and you like analyzing company performances, direct stocks or individual shares can be very exciting and very rewarding for you. Number 2, if you're looking for potentially higher returns than money market funds, than equity funds, then individual shares are for you. Although they are riskier, individual shares offers a chance to outperform equity funds, especially if you can identify a very strong company in early stages, or you can identify a strong company or a company that is doing very well. Number 3, if you have a long-term perspective, stock markets can be volatile in short term, but patient investors often benefit from substantial gains over years or over a period of time. Number 3, if you're interested in individual and passive income, certain Kenyan companies, they offer good dividends, and you can take advantage of that. You can go for companies that offer dividends, and you invest in them, and you're going to be receiving dividends as your capital is growing. Okay. Number 4, if you want more control in terms of deciding where your money is invested, you need to go for individual shares. You can decide where your money goes. No intermediaries, no fund managers. It's just your call. When you make losses, you know it's on you. When you make gains, you know it's on you. So guys, if you're okay seeing red in your portfolio without panicking, you know your risk tolerance is high, and you can, weather the short volatility and wait for longer term gains. If you have already built a financial safety net, you have money in safe investments, and if you want to build a customized or a personal customized portfolio, then you should go for individual shares. Now, if this is you, I have created an ebook which contains everything you need to know about investing in shares. It also includes links to resources you need to be monitoring share prices, links to evaluate companies and their financials, as well as step-by-step on how to buy shares and also how to make money in shares. It has everything you need to know about investing and making money with shares. The guide goes for 590 Kenya shillings, and if you're interested, you can reach me on my WhatsApp number. Here is my number. I will also leave the link to the book in the description box for those who prefer maybe paying through a card or maybe a PayPal account. And I would like to hear from you based on these differences. Where do you fit? Let's see which one is best for you. Equity funds, shares, or none of the above? Let me know in the comment section. And thank you so much for watching. Happy investing and bye. See you in our next video.